Welcome back to the Infinite Banking with series. Today, we're going to be going through One America. And One America, we're going to be looking at the company, when it was founded, the company's strengths, dividends. We're going to look at how they do loans, their average lapse ratio. We're going to be looking at illustrations, the cash flow design, the front load design. We're going to look at the PUA flexibility. And then we're also going to look at their long-term care rider, go look at their advantages, some considerations, and then also do an agent overview as well if you're someone who's in the business and looking at like, where do I want to get contracted? Without further ado, let me welcome Alden Armstrong. And Alden, I just, again, want to give you your flowers. You've done a phenomenal job so far in this series. I have loved doing this with you. This is just going to be life-giving for so many people. This is probably the biggest question we get asked when it comes to infinite banking is what companies. And we obviously represent and work with so many great ones. And so we wanted to put this series together to just give people a little bit of more insight if they're life insurance nerds themselves and want to do deep dives. And so this has been fun and very much look forward to going through this company. And I just have to say, I love the people at One America, and I'll share some fun nuggets throughout this video of some things that maybe no one knows, but it'll be fun to kind of share some inside baseball on just my experience working with this incredible team.
Absolutely. Well, thank you, Caleb. Appreciate the introduction. Guys, IBC with One America. So let's dive into this. I know a lot of IBC practitioners use this carrier, so you may have one of these policies. Hopefully you understand it as well. All right. So One America, big thing, a lot of people talk about this online, is that they are a mutual holding company. Now, what that means, basically they were founded in 1877. They've had 3 different names over time. Technically, they were the Knights of Pythias, I don't know how to say that, of 1864. And then they reorganized into America United Life in 1877. They then, from that point, restructured again in the year 2000 into a mutual holding company. And so there's a lot of reasons for this. We're not going to go into the history of mutual holding or mutuality in general in this series, but just understand AUL, you're going to see that on your illustration. It's the same as One America in this instance. They are a strong dividend paying carrier. They've been doing it for almost 130 years. Now, I will say every other carrier was very clear on when they started paying dividends. I found some conflicting information on One America and AUL's websites. They conflicted with each other. So I don't know what the truth is. Somebody educate me if you know for sure, please. All right. So financial strength and performance. A couple of key metrics that we track and we take a look at every year is going to be their dividend payment. So what did they declare and what's been paid to policy owners? That's going to be about $36.5 million. And then their dividend interest rate. Now, this is a unique thing with One America. They don't actually tell you. They don't publicize their dividend interest rate at all. Another carrier we're going to talk about, Emeritus, they don't publicize their declared dividend, but they tell us the rate. So every carrier is a little bit different. This is just an interesting nuance here for sure. Now, a newer metric to the channel, but one we've been covering in each one of these videos, is the average lapse ratio. So lapsing, 1035ing away from a carrier to another carrier, stop paying on the contract, take your cash, put it in your pocket, or the internal charges of that policy exceed the cash value that policy lapses. And so in those circumstances, those would be the events that affect this number. On average, we see around 5% across insurance companies in the industry. One America is right there, right near the average. So what this says is that effectively they have a, let's say, average or good satisfaction from their customers, from their clients, and they maintain their policies over time. So this is a metric that I find very important. We're going to see some much higher lapse ratios in later videos in this series. But for One America, strong carrier, been around a long time, and they do operate off of a non-direct recognition for loans, which can be very helpful. We're going to have another slide on that as well. As far as the ratings is concerned, ratings with the mutual holding company is a little bit confusing because we have ratings for the company itself and they have ratings for the holding company. When we're looking at this is for the One America providing the products. This is 95 on a COMDEX, so top 5% of insurance carriers and an A+ superior rating. Now, one thing I'm going to mention that I just think is really important to understand, One America has a diverse product lineup. They actually lead the market in hybrid long-term care solutions. Their asset care and annuity care products are incredible, very, very strong. And we actually do a decent amount of business on their long-term care side as well for clients looking for those solutions.
A couple things I'll just note is the not publishing their dividend interest rate is not a red flag for us, mainly because we can run the illustrations and we compare based on internal rate of return anyways. And so a company could be like 7% dividend rate and 5% dividend rate, but that's just a gross number. There's other things that make up the actual like net dividend that you're getting, and that all can be shown via an illustration. And so that's one of those things where each year we'll just run and compare, and we don't necessarily try to get caught up in the dividend hype world. And so that's just one of the things. And then they are slightly below average, but their lapse ratio is a little bit higher than some of the big companies, which is going to be somewhat standard for a small. I mean, all these companies are big, but they're a smaller carrier when you start comparing them against the Guardians and the masses of the world. And so that's obviously something that's pretty standard. Being non-direct recognition, we take a stance that it really is not that big of a deal, whether it's non-direct versus direct. But that's obviously a huge plus when a lot of people choose to work with a carrier, is they like the fact that it's non-direct recognition, meaning it's just a lot easier when it comes to working with a carrier, understanding, like it's just easier across the board to explain. And then they have a healthy COMDEX score. Anything above 90, anything A plus is just really solid across the board.
Last thing I'll mention on the dividend interest rate, guys, Caleb made a very, very important point. Now, when anybody works with me and says like, hey, I want the carrier with the highest dividend rate, usually that's Mass Mutual. What we see, and if you go back and look at the videos and the summary will do, dividend rate does not equate to internal rate of return. It does not directly translate to having the most efficient product. So again, the fact that they don't publicize it, it's not an issue for the way we do business. All right, so positioning for IBC. They are very well known for IBC. There are a lot of IBC practitioners that specifically work with One America because of their non-direct status, because like Caleb said, the culture at One America is amazing. A lot of really, really great people that we've connected with there. And they are in general supportive of the strategy. Now, there's no official endorsement. So I think from a company perspective, that could be a little bit foolish for legality reasons, but they do attend and sometimes sponsor events that are around the infant banking concept or high cash value life insurance. They're also, if you're an agent, you'll notice IBC referenced in internal materials. So they're aware of it, they understand it, and they want to provide that service to their clients through the products that they offer. One of those products, the best in my opinion, is going to be the Whole Life 95.
The other thing that I'll mention is when you're thinking about doing an infinite banking style policy with a carrier, there's pros and cons, being big, being small, and all. And there are some companies that you're just a number. They kind of almost don't care if you do business with them or not, or they're definitely not going to cater to doing this business well. And so sometimes that can show up in like underwriting. Sometimes that can show up of like, hey, why are you putting so much money in? They don't fully maybe love the fact that you're trying to overfund, and they make your life more difficult. But there are companies, One America being one of them, they know that this is a big part of business. And so even when it comes to like cover letters and underwriting, they are willing to work with you, and they're much smaller, but also that can be an advantage because you can talk to people that have a lot of influence in getting business through. And so that is one of those things that I think we need to do maybe a better job in this series going forward, is kind of giving some inside baseball when it comes to just like how working with these carriers work. That does matter sometimes when you're looking at underwriting, when you're looking at making exceptions. It's a lot easier to get an exception when you can be heard, versus when you're just like writing to some help desk ticket, it can be harder in some areas. So that's what I'll say about One America. And they just have an awesome team that not only gets this, but they really do their best to make sure that the experience is good.
Absolutely. Great team that we've found with One America for sure. So diving into the illustrations and the real numbers, something that we're going to see with One America policies is that they're not as competitive, but they're what I call workhorses. They perform very closely to as they're illustrated because they're very conservative in their illustrations. So from a cash flow strategy, Caleb, give us a quick definition of what that is.
Cash flow is someone who wants to fund the same amount of premium every single year. Obviously, there's flexibility designed into that. And then the front load is essentially saying, hey, I have some lump sum money that I want to put in, but I don't want to put that in every single year. So I'm going to put it first year, I'm going to front load, and then I'm going to put in a lower amount each year. And obviously, we have a video at the end where we're going to compare all across the board. And I will say, One America, this is where they don't shine. If you care about the illustration growth rates, to play devil's advocate, is they're just like, we want to be more conservative. We want to be the company that is more conservative. they may have an internal opinion that some companies out there are maybe being a little bit more aggressive, and they just want to be like, hey, we don't want to be that company. We want to be conservative. But you will see that the cash value early on might not be as attractive as some others, and the long-term growth may not be as attractive as some others. And that's just the stance that they make when it comes to illustrating. They see it as a pro versus a con.
So I think that was well said, Caleb. Cash value access, as you mentioned, in the first year, it's fairly low as compared to some competition. So 60 to 75% is what we typically see in the first year for cash flow design. Now, again, I've mentioned this before. Sometimes we can buck that ratio a little bit if we're highest rating, really young. But in general, this is where we find most of their insurance products illustrating. Now, their design, because the illustration is not super strong, their dividend is not as strong as some of the other insurance carriers. At least that's what we can assume. They don't actually tell us the percentage rate. Long-term funding is recommended for this type of product. Up to the product limits, whatever the product allows, is usually how we encourage our clients to fund these products up to the max for as long as possible. Now, to Caleb's point, they're not winning any foot races here or horse races. This is what I would consider a workhorse product. So it's consistent, it's conservative, and albeit below average from an illustration perspective, in the long term, internal rate of return averages around 3 to 3.5% with the current dividend projections. All right, now diving into some specific numbers, this is their whole life 95 product. Same illustration, same individual we've been looking at for other carriers. So it's a 40-year-old male, one level above their standard rating. So with One America, that's select non-tobacco. And we're going to be looking at that same illustration, right? $50,000 a year in premium. And on the right-hand side, we're going to see that total outlay happen for 20 years and then zeros moving forward starting in year 21. So what we're doing here is a premium offset. That policy is not going to pay for itself. Cash in the policy is going to be slightly surrendered to pay for that minimum premium, but the growth overall is strong enough to maintain consistent growth in the cash value and the death benefit. So as we look into the policy projected illustration here, we got that 50,000 the first year. Initial cash value is about 36,000. So it's not around the higher end of what we see, typically about 75%. The death benefit is about $2.4 million. Now, something that I've talked a lot about in previous videos, as I've said, if you don't see the death benefit doubling within about 10 years, it's probably not a well-designed product. And I usually, if I'm paying attention, I usually say, but there's exceptions. This is one of those exceptions. Some insurance carriers offer what's called a 1-year renewable term product that attaches to their whole life. What that does is it maintains the death benefit at a steady rate until the term drops off. So effectively, if you've seen the Guardian video I did, it's very similar. We have 1-year term insurance that is on this product. Every year, as your paid up additions and the dividend buy more permanent insurance coverage, the amount of term that we need to maintain the death benefit is going down. So we have 1-year term that over the course of, in this example, about 13 years is completely replaced. And now we have that growing death benefit. So Caleb, any clarifying points there, or was that good?
That was good. In other words, your death benefit is increasing. You're not really seeing the big difference because they're automatically tailoring down the term. Your permanent death benefit is increasing. Other carriers that we see that, start maybe in the 1 million and then at the end around 3, and you're just not going to see that in this illustration. And you can also just point out that you have less cash value access in the first couple of years, and your death benefit is higher than other carriers. There's no free lunches in the space. It doesn't necessarily make something good or bad. It just is what it is. That's just a reflection of one of the values that One America has. And so that's what I'll say about that.
Yeah, that's perfect. Definitely always trade-offs. The insurance company never loses. Some products like, oh, wow, how are they making money? Well, I'll tell you if you want to have a conversation. But Caleb makes a really, really good point there. So we look back into this policy, a couple of key metrics that I track and I explain with my clients is one is the capitalization point, and then 2, the break-even point. Break-even is self-explanatory. Capitalization is that point where now the policy is giving you more growth in that policy year than what you paid in premium. All right. So looking at this illustration, we're going to find the capitalization point. And so what we're looking for is when do I have more growth between these years than what I paid in premium, which is at 50,000. So as you can see where I'm highlighting, year 3 and 4, you pay 50 grand, and now we've got more increase, just over 50 grand in that time frame. So cap point of year 4. The other metric we track, right, or the ones that some people really care about, and Caleb, I'd love for you to elaborate on that, is going to be the break-even point. So Caleb, go ahead and take it away there.
Yeah, break-even point is essentially when you have more money than what you've put in. This looks like it is year 8, Alden. That's just essentially says when you're comparing other policies, when you have more money than what you put in, it's not that it prohibits you to use your money before it breaks even. It's just a metric that we look at. And then the other metric that we care a lot about is internal rate of return. And that's just the actual growth rate that your cash has. One theme that I'm seeing is, when it comes to capitalization, when it comes to break evens, when it comes to internal rate of return, One America is not winning any awards. And in fact, they're probably more on the low end across the board when it comes to how they illustrate.
That's right. So for those taking notes and wanting to do some comparison before we do the final video, for all you overachievers, we'll be looking at the cash value at the end of the 20th year. It's about 1.38 or almost 1.39 million net cash value, and then a let's say $2 million total death benefit 20 years into the future. Now, coming back over, we're going to start looking at the second way to build an insurance policy in general, the way that we build them, cash flow or front load. So front load insurance, same product, still that whole life 95. And now we're going to be looking at what I call the variable effectiveness. So big words, what do I mean? One America is a little bit unique in that if you put in a certain amount of money, you get a certain result. If you put in slightly less, you may get a much better result. And this, I think, speaks to their target market. One America does a lot of small face value whole life insurance policies. They are far more bullish on their long-term care side of their business. They don't put as much focus in the whole life or life insurance space. And so with the Whole Life 95 product, with the way that we can build it, if you want to front load over $100,000, you're free to do so. But then that initial cash value percentage is that 65 or 60 to 75% number. Same as the cash flow design that we looked at a second ago. However, if you do that $100,000 or less, we can get that first year cash value to be close to, if not above, 90%, which makes it a fairly competitive product in the front load space.
It's interesting. Most carriers work the opposite. Is like the more money you put in, the more like benefits you get. And it almost looks like for the smaller front load opportunities, they become more competitive and they become less competitive, the bigger front loads, which is interesting. But we're still looking at an internal rate of return of 2.9 to a little over 3.4%.
Yeah. So the competitive nature comes in with how much cash can I get right away? The growth it still kind of lags behind. So they're definitely ideal for that higher cash value under the $100,000 funding. And then in general, long-term, they are a below average projected growth. And I've italicized that word on purpose. Remember, these are all projections. The future performance of the policy is going to depend on the dividend and what they actually pay, not what they projected that they're going to pay. We have to remember that One America is a very conservative insurance carrier. We see that on their underwriting. We see that with how they illustrate. So you may actually be getting better internal rate of returns than what we're projecting because of how they illustrate. But again, we just can't show those numbers. The numbers that we can show are the ones on your screen. So we're going to be looking at this Whole Life 95, same fact pattern as before, 100,000 the first year and then 50,000 through year 20. Now, we're able to get a higher percentage of cash value, upwards of 85%. For younger individuals and for the highest health rating, we've seen 90 or slightly above 90 for this under $100,000 front loaded amount. So in that first year, put in 185,431 projected cash value at the end of the first year once the dividend is paid. Total death benefit, this is the same story as before. We're using that 1-year term insurance. You can see that here. And then the total death benefit stays pretty much the same for about 13 years before it starts to grow again. Now, looking at those couple key metrics that we looked at last time, we're going to see capitalization point and then the break even as well. Now, the interesting thing with One America is that the capitalization point and the break even don't change a whole lot even when we put in a larger volume of money. And there's a lot of reasons for that. So looking over for some of those key metrics, we can see that the capitalization point is basically year 3. It's technically year 4, but year 3, we're giving them a little bit of grace here. Increase of about 50,000. They're about $250 short. So almost that year 3 capitalization point, which is pretty strong. Now, the break-even point, we did a little bit of a switch because of slightly more money going in the very first year. Breaking even coming out here to year 7. Instead, when we looked at the other policy, it was year 8. And so bring that forward just slightly, put in 400,000, we have 408 at that time. For those comparing, as I said, overachievers, we've got about 1.49 million in total cash value at the end of the 20th year. And then we're projecting a $3.4 million death benefit projection as well. So Caleb, any thoughts, comments?
The thought and comment that I had is early on in the space, One America was one of the first carriers that we would do front loads with. And in the past, I would say were a lot more competitive when it comes to their illustrations. And then they decided a couple of years ago to say, hey, we're going to go a different direction and we're going to be conservative. We're going to stand by our numbers, but we're not going to try to win the illustration race. But the front load was one of the things that I learned and would do when it comes to One America. And, that's all I'll say about that.
Yeah. And it's a great point that in general, insurance companies change, products change. The nice thing is that if you get a policy today, whatever they do to change the products in the future don't affect you because you already got your policy. So, shameless plug, but go get it now.
Hey, I'm interrupting this video briefly to say, if you're serious about using whole life insurance for infinite banking, we have a free gift for you. It's called the IBC Company Guidebook, and it gives you inside access to the data behind these videos. Things like life insurance company COMDEX scores, their dividend performance, how they approach infinite banking style policy designs. It's all the information we cover in these videos organized in one place for easy reference. To access the guidebook, click the link in the description or pinned comment. Now let's get back to the video.
Now, when we start looking at the access to cash value, we can tell that their target market is actually small face value infinite banking style policies. They do a lot of these. And the reason I say that is because they have lightning fast access to cash value. It's the fastest that I've seen in the industry. There's another carrier that's under 30 days, or actually two other carriers. One American can get a policy loan initiated within about 2 weeks. That's pretty fast. So for small face amounts, small initial premiums under 100,000, put it in, get it out fairly quick. Now they are, as we mentioned before, non-direct recognition. So they have a variable loan rate system. And then small loans can be initiated through their online portal. Larger loans, like we've been seeing with a lot of carriers, go through your agent or directly contact the carrier, and they usually require a signature verification due to anti-money laundering best practices. Now, this is something that personally I find a little bit annoying because you have to think about interest a little bit differently. When they charge interest on their loans, they charge it in advance. Another carrier that we work with that does this is Guardian. Charging the interest in advance, and then upon your repayment, if you pay it back early or you're paying it back incrementally over time, they're going to credit you back. So you end up in the same place. It's just a little bit harder to pay attention to or to understand, let's say, if you just look at the numbers on your portal.
So another way to say this is if you take a $10,000 loan, they'll take out, or I say take out, but it'll be 10,000 plus the loan interest all at one time. And then if you pay that back half the year, then half that interest just gets credited back to your availability. Again, non-direct recognition, meaning you're still getting paid the same regardless if you have a loan outstanding versus not. That's how they go about it.
Yeah, absolutely. Now, this is actually one of my favorite slides. If you've seen these, this is usually when I get a little bit more excited, I start jumping up and down. But paid up additions flexibility to me is extremely important. One America is really unique in that they have basically no restrictions on their paid up additions rider. There's a couple of highlights here I want to point out for you. They accept what I call anytime payments. So a couple carriers do this, but they allow you to fund up to 3 times the base premium at any point in any number of payments. You could do 1,000 at a time up to 10 grand over the course of 10 months. So that I think is a really cool flexibility feature. Now also, the restrictions are fairly minimal. Apart from just needing to have the paid up additions rider on the policy, if you want to keep it, pay $120 a year and you're done. So as far as a minimum is concerned, it's very, very generous. So year to year, if your cash flow goes like this because you're in sales, maybe you were in the mortgage industry about 3 years ago, and then all of a sudden your sales went down, this type of policy can be really helpful because it allows that flexibility to weather the storm of your cash flow situation. So this last one, this is actually the only really area I have a bit of a con with this particular paid rider. Now, the interesting thing is that they give you a lot of flexibility year to year. They do provide a catch-up provision, but that catch-up provision, they kind of limit you to how much you can catch up to the average of what you've been paying for the last 3 years. So as an example, if you have the ability to put in 15,000 of paid up additions, but you're choosing to put in 5, and you do that for 3 years, starting in year 4, if you wanted to catch up last year where you could have paid an extra 10 grand, they'll only allow you to do 5 because that's the average of what you've paid in that last 3 years. So that kind of limits the backfillability. However, if you're funding it like we encourage and like we design them to fund it to the maximum every year, you still have that backfillability because your average is going to remain high.
And is it is simple to say that if you at least pay half your PUAs, you could backfill and take advantage of that? The other thing I'll just say is the $120 a year minimum, like that's almost a must. Like regardless of what's happening, make sure that you get that done. And that this is another thing that doesn't necessarily show up on illustrations across the board. Like they are flexible. Going back to, there's a common theme here. Going back to, they're a company that supports these style of business. They want to, the fact that they give you fast access to money. They have people on their team that understand that people are going to be taking loans against their policy. This is an example of saying, hey, we're going to make this really user friendly and accessible when it comes to flexibility. And that's something that, you know, may not show up on their illustration when you compare to other carriers. Other carriers might look better. If you don't optimally fund these other carriers, One America could very much beat out if you just understand flexibility. That's almost impossible to illustrate out because we just don't know what the future holds. But it is something I'm grateful for that One America does.
Absolutely. Flexibility in PUAs, as I've mentioned before, it's really important. And I have a great quote from a friend of mine at the end of the video that kind of describes why this is so important. So a couple other things to know is they, as a company, they're focused on their long-term care products. Their whole life, they sell a lot of it, just because they are a bigger company. But arguably, the best mutual insurance carrier that offers hybrid long-term care products, period, in my opinion. To say that One America is a big player in the space is actually a huge claim because they're a small company. There are other mutual insurance companies that sell long-term care hybrid products like Nationwide and like Pacific Life. Technically, those are both mutual carriers, but we don't often hear about them because they don't pay dividends on their whole life products. They're not participating. So One America, they definitely shine in the mutual space, offering that participation in their whole life products and providing a really strong long-term care product as well. And the other piece, just because we've been covering it with all of our carriers, is the theme we see: smaller insurance carriers, they just choose not to deal with New York because New York is frustrating. So 49 states plus DC, not available in the state of New York.
I just point out that long-term care is a big focus, and there are a lot of reasons to just work with One America just on the long-term care, or at least have the ability to do that. They have some very unique products that can blend long-term care with whole life. It's pretty neat. And so that's one of those things where I'm not sure we may do more videos. I think we've maybe done at least one video in the past. If we did, that will be down below. And if not, we'll make sure to do a video just on their long-term care capability, because it is something that I think is going to become more and more popular, and One America shines in that area.
So coming back to the wrapping up of this particular carrier, we're going to go over the advantages and the considerations for this. So the advantages, they've been doing this a long time, 125 years. It's one of the few insurance companies I've seen that has 3 different names when it comes to where they were founded, then they switched, and then they switched again. But the point is, they've been around a long time and they've been paying dividends for that time period, about 125 years. Another thing is that they are very pro IBC. While they don't specifically endorse it, they are definitely active within the IBC community, and a lot of IBC practitioners work with this particular carrier. Another advantage, like we mentioned, their target market seems to be under $100,000 of initial premium. So we're looking at those smaller face value policies. You can get up to about 90% cash value the first year when you front load under that ceiling of 100,000. Another advantage, and to Caleb's point earlier, you can't really illustrate this. This is just something you have to understand when you buy the product. Very flexible with regard to how you can use that paid up additions rider underneath the MEC limit. The last thing, I just waxed eloquent on this a second ago, but they are a hybrid giant in the long-term care space. It gives them a lot of revenue from something unrelated to the life insurance arm, which I think is really important.
One note that I would make, Alden, is you're saying the high cash value for small front loads. I think that's generous for you to say that this is an advantage. Obviously, it's competitive, but there's other carriers that we know that from a front load standpoint potentially could get higher early cash value and performance, but it is one of those things that we wanted to mention. I think their customer service is, a huge advantage, and just working with a carrier that understands this. You can get early loan access, again, going back to underwriting, and when it comes to just like understanding the situation, they, 10 out of 10. And then the fact that they're a hybrid long-term care giant is a huge plus, and really opens up a lot of opportunities for that style worth of planning. So that's just my overall thoughts when it comes to the advantages of a company.
Awesome. Thanks for your thoughts there, Caleb. That was great. All right, so jumping into the considerations. So, what you should understand before doing business with One America. They do perform and illustrate, on average, in the bottom quarter against other mutual insurance carriers. So, they're not very competitive in that perspective. They do also have a decent amount of growing pains. And so, customer service historically has been very, very strong. But because in the last really 2 to 3 years, we've had an increased market share within One America, a lot of IBC practitioners started working with them. Their rapid growth has caused some growing pains. So customer service, a little bit lackluster at times, but also the underwriting side of things, they've had to do a lot of internal adjustments to keep up with the amount of business that they're doing. So every carrier goes through this about once every 5 years. They realize that, oh no, we need to hire more people or train some AI. And so One America's been dealing with that last couple of years, but they're on the upswing for sure. We mentioned that they illustrate conservatively. The other aspect of this is they also underwrite very conservatively. We've gone into having situations with One America where we get a standard rating and then another carrier gives us preferred plus. So it's not the norm, but in some circumstances, if you do have a complex medical history, One America may not be the best first stop for you. And oftentimes, if you really want a One America policy and you got some medical concerns, we're going to do a competitive application with that carrier and another one to make sure you get the best offer that's possible. Now, one of the pros was the PUA flexibility, but I'm also going to say that there's a little bit of restriction on the PUAs. They limit us to about a 25/75. If you're familiar with a 1090, 40/60, 25/75 is the largest degree of cash we can shove into a policy with this particular carrier. I find that, just as a person who loves the insurance design aspect, a little limiting. And at the end of the day, the product still works. We just can't get as much extra cash into it. The last thing, and Caleb mentioned this, it's not a real issue with how we do business, but some would consider not publishing their interest rate to be just not totally genuine. So I wanted to put it on there because it's something that I have heard said from other insurance agents as well.
Yep, I think it's well said. The PUA restrictions, like not being able to go more than that, the ratio can be very frustrating. And then the underwriting, I love the fact that you say it can be a pro because again, if you want to be with a company long term, you like the idea that they're not just going to let everyone and their neighbor. Every company has different baselines and all, but yeah, it can be very frustrating when you're in a competitive. If you're looking at different carriers and one carrier comes back with such a crazy rating, you're like, okay, even if yeah, it's just underwriting does matter a lot, and that's one of the reasons why you probably should work with someone that has access to multiple carriers and looks at it because every carrier is going to underwrite a little bit different. But across the board, One America has been more on the conservative end when it comes to who they approve and how they at what status they approve for.
That's right. Circling back around, starting to land the ship here, something I like to throw in is just what's the agent perspective? So if you're on the outside looking in, you don't work with One America, or maybe you do, you just want to know more. What does this look like? So compensation at this carrier is actually, it's average. However, depending upon your production, and if you have a GA contract, it can push your compensation into the top 2 to 3 spots in the top 2 to 3 in the insurance industry for mutual carriers that we work with. Like, obviously, I can't speak to other carriers, but for the carriers we work with, top 2 to 3 it's a big deal. So pay can be very, very strong. Compensation tracking can be cumbersome. That's kind of the theme across all these carriers. Very few of them do it very, very well. Because One America is a smaller company, I would say their support is average, and specifically on their advanced case design. The team that they have is incredible, but they're also overworked. It's a small carrier, it's a very small team, and if you want to do any advanced planning cases or larger premiums, the communication can be a little bit delayed just because it's a small team. That said, one of my favorite people to call for advanced planning is at One America in their advanced planning department. So all said, smaller carriers, you are much more known as an agent and in some cases as a client, but you don't often have the robust support system that the major mutuals can compete with. The nice thing about One America is their products are pretty darn simple. So I gave this a 5 out of 10, and there's some specifics around the different term insurance riders that they have that can be a little bit complex, but it's a fairly simple product. And so Caleb has mentioned in other videos, simplicity can be king, especially coming into the industry as a new agent. So this may be a good first stop if you wanted to do insurance policies. Last thing, your insurance software is old school, but it does function well. If you also work with Lafayette Life, One America and Lafayette Life share an illustration system. It's the same architectural design. But the downside is they don't have any option for multiple plans. So if you want to run multiple iterations of the same insurance policy, showing different funding, different riders, it's a bit of a bear to go through that process. You can't do it all in one space. All right. So conclusion, guys, where does One America really fall? At the end of the day, they're an IBC friendly carrier and they provide a solid whole life product. I've described it as a workhorse and it is a favorite among IBC practitioners. This is the big but. It's the however, right? The product itself falls effectively on its face a lot of times when you're comparing it to what's available in the marketplace. This is a big reason why we love the carrier in a lot of ways, but we don't do a lot of production with them at this time because of how they perform and how their growth and accumulation is taking place in their products as compared to some of the competition.
What I would say there, Alden, is a lot of times our process is we're giving people choices and we try our best to give pros and cons. And while some people love the pros of many of the things that we mentioned at One America, it's sometimes hard to choose them over other carriers when you're seeing maybe such a big difference when it comes to some of the ways that companies illustrate. And so that's one of the things that we try our very best to be as transparent through the process as possible. They were one of our go-to carriers, and then when they a couple of years ago when they decided to be like, hey, we're going to go this different direction when it comes to being more conservative, nothing but respect, we've stopped doing a ton of business. Really, it's because of that. There's no other reason other than what you just mentioned. I think that was well said.
As my good friend Abraham Lincoln said, we're we're looking at the product, right? The product, its design, and how you understand it is what matters most. The carrier itself, in my opinion, does not, or in his opinion, does not matter as much as among top mutuals. Now, this is where we could be splitting hairs. One America is a very small company. Are they a top mutual? Are they not? It's kind of up to you to decide that. But my point is, a whole life product, if it's built right at that carrier, is still going to perform well and as a workhorse because of the type of asset that it is.
Just in case you represent Abraham Lincoln's Foundation and you want to send us a letter, this is a joke. This is a joke. I gave Alden a hard time early on by quoting himself, and we it was like an inside joke. And so he's decides to up it a notch and just give people like Abraham Lincoln credit for something he never said. So
It's
there you
you
go.
know it's always funnier if you don't explain the joke. Gandhi said that, I'm pretty sure.
Yeah, right. Okay. The thing I just want to say is if you need a policy review, if you have a policy with One America and you want someone to review it, if you are interested in saying, hey, I would love to see what this would look like for me to get a policy with One America, we would love to have a conversation with you. We have links down below. I would say policy reviews have been very common when it comes to this company. And so we just wanted to acknowledge that. If you found this video and this series valuable, I can't tell you how valuable it is to like, subscribe to our show, comment, like all of that. Even YouTube watches our watch time. Like, what is the average person watching our videos? And then they, based on your habits on YouTube, promote it to more people. And that's like a free way to say thank you. And if you've not hit the notification bell, please do so because we're coming out with some other bangers in the series. And at the end, we're going to compare all the illustrations that we've done with all carriers, and that video is going to be great. You don't want to miss that. So make sure to hit the subscribe button.
Absolutely, guys. Looking forward to future videos with you. That big comparison at the very end is going to be very telling across the carriers we work with. So stick around. We'll see you later.